Hello and welcome back to the Mind and Money podcast. I'm Sherry, a financial coach.
And I'm Val, a financial planner. And today, we're a couple weeks, maybe a month, whenever we release this, it's hot on my mind because we are just through RRSP season. So the RRSP is a registered account here in Canada, and it was born in 1957. The TFSA, there's so many acronyms in finance, but the TFSA was born in 2009, I believe. We're not talking about the TFSA today necessarily. 2009? Wow. That seems way too fresh. But yeah, we're talking about the RRSP as a tool and I'll say like the bad rep it gets currently and where it's a tool that we can use and where it does or doesn't make sense. This is not financial advice. This is a conversation. Disclaimer.
This is never financial advice.
Never.
Yeah.
So
also, quick fun fact. Apparently RRSP is not an acronym. Apparently acronyms are only when you don't just say the letters that go along with the words. So here's a very Ontario one. The Liquor Control Board of Ontario is our liquor store. Some of my friends call it the LICBO.
Yeah.
So if you call it a LICBO acronym, there's some other word for when you're just like pronouncing the first letters of a short form.
If you called it the RRSP.
Yeah.
Oh my God.
It's like an alphabet. Yeah. Anyways. Okay. Back to our regularly scheduled program.
Oh my gosh. Okay. Well, for the breakdown, the Registered Retirement Savings Plan, RRSP, otherwise known as RRSP, is a tool I'm finding with generations that were really encouraged. Like, I'm sure it was when this is a new account. This is a new exciting thing. Put your money into RRSPs. Now, 50 years later,
it's a lot more than 50 years. Because it's not 7.
Right. No. But
I know.
It's not my 70-year-old clients that are upset about it. I'm like, it's the clients that are 50 to 60. So when you make the withdrawal from the RRSP, it's taxable. So the way that the tool works is sometimes surprising to them when they're like, what? I have to do this. Now, mind you, when they put the money in, it either lowered their income taxes that we're owing, or it generated a refund. So at that point, X amount of years ago, dopamine, happiness, amazing. Look at this, awesome. And then we get to the point where we take it out when it's taxable. And there's some different feelings around it.
Well, and I think there are so many different like investment vehicles in Canada, the US, around the world. And people hear that, you should invest in your RRSP, your tax-free savings account. Here's where you put your money. And then they do that without a full understanding of
what's best.
Understanding the tool, understanding the tax sheltered account, and making decisions based on not only the result of putting it in, but the result of taking it out.
Yes. Precisely. So when you hear like rules of thumb around those accounts, it still probably doesn't apply to you because it depends on what your goals are. It depends on when you need the funds. There are so many pieces. So it is a good tool, but it gains a bit of a bad rep when we forget that it did good things for us.
Yeah. Well, and we are looking for that immediacy sometimes. And the immediacy of, if I put money into my RRSP now before the end of February, early March in a tax year, I get to see the impact of that on my tax return for the previous year that I'm filing any minute now. And if that's a refund, you think, woohoo, refund.
Yes.
And then you forget that in 30 or 40 or 50 years when you're taking it out. And I have heard stories of people who have too much in an RRSP that they're having to take it out. And a lot of it, which is the best vehicle for you, is related to your tax situation now, which you have clarity around, and then your tax situation that you believe will happen at retirement, which is a lot less clear, especially the further you are away from retirement.
Right. We can create predictions and we can give our best idea of it. But to Sherry's point, it is around looking at, okay, tax now, projected tax then, and creating a plan. Obviously, if you reach a certain age where there's way too much in RRSPs, and too much is, again, don't take it as advice. But if you reach that point, then there needs to be a strategy to get it out. Ideally, you're working with someone and you're able to, okay, even if you have large RRSPs, how are we strategically getting this out? Like I have one client where between 60 and 65, we are heavy on our RRSPs as main income. So we're getting those out. And then at 65, he has pension Like,
oh, you're trying to maximize withdrawals before other things
exactly.
kick in.
Yeah. Even if he doesn't need it, stuff the TFSA. Then when he is in the pension years, he's got tax-free money too. So that's, anyways.
Oh, the tax-free savings account.
We love the TFSA.
I fucking love her.
Yes.
She has got so much flexibility. And so we're prioritizing putting money into our tax-free savings account now that's outside of work investments that are matched, because we want that flexibility, because you can take that money out tax-free. That's where the tax-free part comes in, on the withdrawal of the tax-free savings account, not on the, you're putting money in with money that's been taxed. But so in my brain, I just think of it like, okay, when we get to retirement years, we create that consistency with withdrawals from the RRSPs, and then the tax-free savings account becomes, you know, our furnace blew up and we need to take a larger chunk, or we're going on a trip and we need to take a larger chunk. So that then doesn't make our tax situation shift wildly from year to year, which then can impact other government benefits and things like that, depending on your income. So that's how my brain looks at it.
Well, you said something there. My brain was like, say that. That's such a good point. Of course.
Well, because well, maybe it's about the flexibility, or just like, if you take money out of your RRSP in an earning year where you're still working because it's some type of emergency situation, like, A, you're taxed up to the wazoo, and B, you don't get to recontribute that amount. Like, you
that
take
room
it out,
is gone.
That contribution room is gone.
Good example of that, client who has an RRSP and has access to a line of credit, doesn't have savings after this conversation, sort of discovering that, dental work, so needs 10 grand.
Oh, I feel bad for their mouth and their bank account.
Yes. But to get 10,000, the withdrawal was actually 12,500 because there's a withholding tax because it's income. That 10,000 lands in his account. Tax time next year, 2,500 on 10,000 was not enough, given he already has a salary. So he needs to be mindful that he's going to need, like, he will owe next year. Right?
Yeah.
So having the TFSA in that case, which we talked about, okay, maybe not contributing as much to RSPs, have some flexibility with the TFSA, would have been optimal for him. One thing I wanted to say, to backtrack for a second, if you have an employer who will match you for your retirement savings, take advantage of it. Like, if it's 2%, whatever it is, because that is a guaranteed rate of return right there of 100%. If you put $1 in and they put $1 in, you've already doubled your money.
Even if you put $1 in and they put 50 cents in,
oh my gosh,
you're not getting that high of a guaranteed return anywhere else.
It is free money for you, for your future. Take advantage of it.
One thing to be aware of in that situation is, if you're newer to a company, sometimes there's vesting periods, when if you were to leave before 5 years, I don't know what vesting, like,
usually 1 to 2.
You might not get to take that employer contribution with you. So just be aware of that if you're not planning on staying somewhere for very long. But yeah, it's money that you're never going to get that, no matter what the stock bros say.
Yes. So take advantage of that. That was all I just want to say.
Well, and we've talked about this before, but no matter what type of account you're using, there's lots of people doing their own investing now, which is great. But whether that's through an employer or whether that's on your own, dear God, make sure that money is actually invested in something and not just sitting in cash in your registered account.
Yes.
Because the registered account does absolutely, especially if it's tax-free savings account, it does absolutely nothing to help you take advantage of the tax sheltering in the account if the money's not growing at all.
Here's my example. The account is the flower pot. So picture a nice terracotta flower pot. The dollars that you put in and or your employer are the seeds. The growth is the soil/fertilizer. If it's not invested, that means you're just throwing seeds into a pot and it's not actually growing because there's no soil.
And you're never watering it.
Yes.
The watering, maybe the watering is like checking to make sure that it's invested based on your
risk
current
tolerance,
situation.
Timeline. Yes. I have come across, one was, I didn't show him the number, but he had been investing for...
Oh, investing. Do we need air quotes?
Investing. Here? He had been putting money into a retirement account for 15 years, but it was in money market, which essentially earns you a very, very, very small amount of interest. It's very safe. It's never going to go down.
But it's probably not going to, like, even with what he was probably...
It's slightly better than what's like money under your mattress. But
yeah, but probably matching or not quite matching inflation. The dollars were probably getting less.
Yeah. So I looked at that to see, okay, if we had even earned 5%, it was an astronomical difference in what he could have had versus what he had. We caught it at that point, and there's no takesies backsies. Unfortunately, with that employer, the advisor that took care of them, it
was not taking care of shit.
Yeah. So anytime a client of mine sets up something with work, I'm like, what are you in? Show me a statement. Show me your portal. Sometimes we make change for for it to be more growth focused if that's appropriate for them, but make sure you check.
Yeah.
And you don't have to figure it out on your own. You can ask your person for that.
Statements can be really overwhelming,
especially if it's like, oh my gosh, some
of
them.
It's like they're like, okay, we could do this by putting like 6 lines on one page, but what if instead
we make it 18 pages?
We do 6 pages and we have 25 lines on every one, just so we can completely mystify people, so that they feel overwhelmed. And I think that's happens a lot with the financial industry, and especially around taxes, especially in Canada, is we create the beliefs, and like the system creates the beliefs that, oh my God, this is so complicated. Like, you've got to pay somebody to do your taxes. And dear God, I will shout this from the mountaintop. If you are an employee and you do not have a complicated tax situation, you can do your taxes yourself in less than 15 minutes. If you have a CRA My Account, you can go on to a tax program. I like Wealthsimple. You can do it for free. You can do it by a donation or different tiers if you want to have someone view it or something. But you can go in, you can fill out your personal information, you can click a little button and say, import my information from the CRA, and then it will then link you to your CRA My Account, and it will ask you what documents you want to pull in. And you do have to check to make sure, like if you're an employee, that you see a T4, if you've got investments, you see
your RRSP slips.
And then it just plunks it all into your tax form for you. And then there's buttons you can hit to review and get suggestions, and it will walk you through things step by step. And it's more challenging, I think, in the US and in some other countries because there's state and federal. But in Canada, with the exception of Quebec, you fill your information once and it's all done. You're federal, you're provincial, you get one refund or you have one amount owing all at once. And then, you don't need to pay somebody to do your taxes. I promise. Now, incorporated self-employment, there's more to it then, but even simple self-employment, like it's not that challenging.
But as to number nerds, the clients that I'll say are even those simple situations, for them, it's, even though it costs less and takes less time, it helps them to have someone that they have to get things to. Like, it helps to separate it because they don't want that chore. Even though we love it, and we're like, yeah, like let me mess around with the numbers. They are like, I would rather pay. So then it's the trade-off, right? So
100%. So if it's something that you just know, you feel debilitated and you're not going to do it or you're avoiding, it's like outsourcing things like that. 100% go for it. But if you're just like, I believe this is too complicated for me to do, and if it wasn't as complicated, I'd try and figure it out myself. It's not that complicated. Here's the thing. If you're just like, I'm not sure if I want to do it myself, hop onto a tax program. Try it. Just don't hit file. See what it feels like. See if you're just like, oh no, I feel like I nailed this. Let's go. And here's the stupidest thing. It annoys me that the CRA makes you file your taxes when you have no like extenuating circumstances. If you have nothing to put on your taxes except like one T4 or maybe like a T4 and an RRSP slip, the government has that information. And the fact that you have to then go and tell the government, well, here's my information and here's I'm filing, because if you enter something wrong, so if you're manually keying in your numbers from your T4 slip and you make an error, you're going to file your taxes and the government's going to be like, oh no, you did that wrong. Like, well, why was I doing it when I wasn't adding anything extra in there? Not like hey, we think this is your tax information. Click yes to file, or click no if you have medical expenses or other things that we don't know about. Just click this. Like, if you don't, just click this one button and we'll file for you. It's a bit of a stupid system, but it's a system that we're in. So
'tis a system.
Yeah, we went off the rails there a little bit. Shocker, but
we can circle back to the RRSP. So it's a tool that can be used, but have someone help you look at your situation. don't hate on them. Like, yes, I definitely think that the TFSA is our favorite child, but the RRSP still has a place at the table.
Yep. And again, with us just getting out of RRSP season, and we call it RRSP season because there's those first few months of the following year where you can contribute and still use the tax advantages of it for the previous tax filing year. So a lot of people like to put chunks of it in or talk to their accountant and see,
crunch numbers and give a ballpark of like, okay, I'm going to owe this much in taxes. How much do I have to put into my RRSP to lower that, make it neutral?
But I've seen a couple of videos where this tax advice or like the financial advice you see online that you should run the other way from, because this one is like, I took out a $22,000 loan and I contributed that to my RRSP. And then the initial thing is he's hinting that basically he took that $22,000 loan, contributed it all to his RRSP, and then was able to pay off his loan with his tax refund. But no, that is not the case. Whatever the number was, I don't remember what they were, but say you take out a loan or you use money from your line of credit or something like that.
You do not get refunded dollar for dollar.
No. So say I'm going to make up numbers. You contribute $22,000, maybe that generates an $8,000 refund. So then you take that $8,000 and you put it on your loan. You still then have a loan. And if you are doing this because you're like, oh, I haven't contributed any money to my retirement and this is going to let me do that. If you're not contributing money to retirement, you probably don't have wiggle room in your budget. And
so
then
now pay interest on a loan.
And then you end up with a loan payment or a line of credit payment every month. And then
now there is situations that it makes sense. They're few and far between. Rarely does it make sense to just do this on a random year on a whim.
Yeah. You've got to see the big picture and understand the big picture. Yes. If you're just like, I'm a hot mess with my money and I'm feeling behind because I'm not contributing to my retirement. And again, social media posts where it's like at 40, you should have this much invested. At 50, you should have, that's bullshit. Again, don't pay attention to that.
Yes, that is clickbait or something. I don't know.
And people do it so that their posts get interaction because then that creates chatter in the comments and then that has more people see their posts. But if you are in a position where you're feeling overwhelmed financially, adding another loan is not going to help you in the long run. It's going to create more stress. It's going to give you a quick little hit of dopamine, and then you're going to then have to figure out how to pay that loan off. And
go big picture. Have someone look at it with you. Don't read that off somewhere and think that you should go do it.
Yeah. And that's the challenge, right? Is we see a post, it should absolutely not be something we're paying attention to because it doesn't apply to us. But lots of people in the comments are saying, yeah, go. And sometimes too, it's not even Canadian specific advice. It's based on like US or other countries. It's like, that's not good for you.
No.
So figure out what's going to work for you and then which account is going to work better. And don't get lost in all the acronyms. And if you look at your statements and you feel like, shit, this is overwhelming, but the person that I can go to ask this question about makes me feel like shit every time I go and ask them about it.
Find a different person.
Yes. There's a person out there that is going to make you feel comfortable. And with anything, especially your finances, if you have somebody you don't feel comfortable asking a question to, that's a good sign to run the other direction and make some changes, because you have got to feel comfortable asking to better understand your financial situation and your investments, because that is a key piece of your life and your future life. So RRSPs, love them or hate them, either way, understanding them is the key. So we are glad you've been here. We hope that you're not feeling overwhelmed with your investments, but if you are and you're Canadian, Val could help you.
I'm here.
Shameless plug that she didn't ask me to do, but she's going to make you feel comfortable. And that's truly the important piece of your money. So we are glad you've been here, and we hope we've inspired you, and we hope you have a wonderful day.